Welcome back to the base school.
Have you ever heard companies talk about sustainability, climate, ESG, and you're just thinking, what exactly are they reporting? Let me break it down simply using IFRS S1 and IFRS S2. What is this all about? IFRS 1 and IFRS S2 are part of the new sustainability reporting standards issued by the International Sustainability Standards Board. In simple terms, these standards are trying to answer one question. How do sustainability issues affect a company's financial performance? So this is not just about being green. It's about money, risk, and future performance. Let's start with IFRS S1, the foundation. It is the general standard. Think of it like this. IFRS 1 equals the rules for reporting all sustainability-related risks and opportunities. It tells companies, identify sustainability risks that could affect your business. Explain how you manage them. Show how they impact your financial position and future cash flows. So this could include environmental issues, social issues, governance issues, anything that could affect the business financially. Now IFRS S2, the specialist. It focuses specifically on climate-related disclosures. IFRS S2 equals climate only. It goes deeper into things like climate risks, e.g. floods, regulations, carbon taxes. Climate opportunities, e.g. renewable energy investments. Greenhouse gas emissions. Transition plans to a low-carbon economy. So while IFRS S1 is broad, IFRS S2 zooms in on climate. The four key pillars, very important. Both IFRS S1 and IFRS S2 follow the same structure, and this is something you must remember. They are built on four pillars. Governance. Who is responsible for sustainability decisions? Strategy. How do sustainability issues affect the business model? Risk management. How are these risks identified and managed? Metrics and targets. What numbers are used to measure performance? If you understand these four, you understand the whole standard. Simple example. Let's say a company relies heavily on fuel. Under IFRS S1, they would disclose fuel price changes and environmental policies may affect our costs. Under IFRS S2, they go deeper. We emit X tons of carbon, and we plan to reduce it by 30% in 5 years. So, S1 equals broad risks. S2 equals detailed climate data. Common confusion. A lot of people think sustainability reporting is optional or just for big companies. But the reality is, investors are now using this information to make decisions. If a company ignores climate risk, it could lose money, and investors want to know that. So remember this. IFRS 1 equals all sustainability risks. IFRS 2 equals climate specific. Both focus on financial impact. Both use the four pillars: governance, strategy, risk, metrics. So next time you hear sustainability reporting, just remember, it's not just about saving the planet. It's about understanding how the planet affects the business.